Hi, I'm Mark Wooster. I'm the Chief Investment Officer for Calibre Investment. We're covering diversification today because we're still in our level 4 bubbles and we've seen an awful lot of volatility in the financial markets. So diversification is always important, but covering it today is a bit more relevant because it's a big driver as to why the portfolios are doing so well in the current environment. So let's look at a couple of examples of how diversification can really help portfolios. In these examples, diversification means allocating money across bonds as well as shares. And so in the first example, a professor from Toronto studied shares and bonds and the combination from 1973 to 2010. So shares performed at a rate of 9.9% per annum and bonds at 7.7% per annum. So in the first portfolio, he combined them at 50-50, a starting ratio of 50% bonds and 50% equities. And the return over the entire period was 8.6%. That portfolio wasn't rebalanced, and so shares ended up at 68% of the portfolio. And then he tried a portfolio where it was rebalanced back to the 50-50 weighting on a regular basis. And the return for that portfolio was 9.5%. And that's really surprising because you actually end up with a lower level of the highest performing asset class shares in the portfolio at any given point of time than the first portfolio. And yet the performance was really not far behind raw equities itself. And in a second example and study from New York, a professor from the University in New York studied the same sort of combination from 1990 to 2011, so a 21-year period. And over that period, a 60-40 split of shares and bonds actually beat 100% of an allocation to shares. So it just shows that diversification is one of the very few free lunches we can get in investment. And true diversification, though, is much harder for people to achieve than we think. So we think it's really, really important to have effective diversification in the portfolios because it's an extremely powerful tool for helping investors who invest over a long time frame. For example, if you're in retirement for 25 or 30 years. So effective diversification in a multi-asset portfolio will assist in managing risk at a number of levels. And so let's look at fixed interest, for example. So if you had fixed interest in combination with shares, if you're trying to offset the volatility of shares by combining that with fixed interest. So in this example, if we had Fund 1 that had 95% government bonds and 5% cash, and Fund 2 that had 50% government bonds, 45% corporate bonds and 5% cash, when you combine that with the volatility of shares, so in a normal market cycle, you would expect if we strike in an economic environment like we currently are in, where there's a lot of uncertainty, shares naturally will decline. But you would expect bonds to be more defensive, stable, and they have actually traditionally rallied in periods like that. So Fund 1 would actually perform okay in that environment because it's 95% government bonds, true fixed interest, and it would stay pretty stable or even rally during that period of uncertainty. Whereas Fund 2, with 50% government bonds, that portion would perform okay as in Fund 1, but the 45% allocation to corporate bonds wouldn't perform so well. It, in fact, would perform much more in alignment with the shares because they're actually contracts with those very same companies. And so that fund wouldn't give you anywhere near the same diversification benefit as Fund 1 would. And so we've actually seen that a lot out in the current environment, is that the fixed interest funds that have allocated more to corporate bonds in the lead up to this, trying to increase the return, haven't had as good a performance during this period as funds that have stuck more with government bonds. So the other example that we can provide is in a balanced fund for the share component. So Fund 1, for example, might have 3,000 companies, a global spread, a spread across a number of industries, a number of political environments, and a whole raft of different types of companies within those industries. Whereas Fund 2 might have an allocation of 45 companies, you would have quite high allocations to individual companies and quite high allocations to certain specific industries. And so obviously there's a lot more concentration risk in that fund. And so if you were building a portfolio, you'd probably want to have Fund 1 as your core portfolio, much better spread, better diversification within that asset class, gives you much more certainty of outcomes. And Fund 2, you might want to allocate a much smaller level to just add to the mix and complement the other funds. So it's pretty clear that, with these examples, there's a myth that diversification is a drag on performance. We saw that with the previous examples that doesn't occur, but you must have effective diversification. And there's a lot more research and evidence that makes it clear that a portfolio with effective diversification and a disciplined rebalancing program produces good outcomes for investors, and especially investors who have a long investment horizon, say if they're trying to get through retirement for 25, 30 years. So just to wrap it up then, it has to be true diversification, there are no shortcuts. And thanks again for watching. Stay safe.